Before I start too, obviously, let's get the disclaimer out of the way. This is not financial advice. I have a very judgmental personality, if you guys know Myers-Briggs. I have the J. So if I say things like, you should, ignore that, disregard it. I'm gonna try to give my just feelings about it, and not give any concrete actionable advice. If I fail at any point, disregard it. I like this GIF I have right here about how easy it is to buy VT. It's just a few clicks, you don't have to worry about it. I almost prepared this animated GIF of like people hyper fast explaining technical analysis, chart analysis, and even just seeing them side by side, you can see just what an enormous waste of time it is. Looking at astrology and reading tea leaves of technical analysis versus just buying an ETF and getting on with your life. I'm gonna say this again and again. I'm gonna make some videos even targeting these communities with this message. There's only a few paths to becoming a high net worth individual. You can be born into it, which you have no control over it, so we can just disregard that. You can have a high paid professional career, doctor, lawyer, somebody in business, something technical, etc. You can do real estate, or you can invest like somebody who's not a clown, or sorry, entrepreneurship, and then also invest like somebody who's not a moron. Those are the only paths available to you. There are no shortcuts, there's no way to cheat. That's it, either you're successful in entrepreneurship, which is difficult and risky and takes everything, takes all of your life's energy and no guarantee of success. You can be born into it. You can play the real estate game, you can have a professional career and save and be responsible, and also on top of that you can invest and do well with investments responsibly by not blowing it all as in your 20s and getting scammed. Those are the only ways around it, there are no shortcuts. Can't do it with penny stocks, you can't just put $100 down and maybe watch it turn into $1,000, but you don't put everything, right? None of that, right? Just put $100 down, turn it into $1,000. Yeah, that's sustainable. I think the people who fall for this just have too much time on their hands. They don't value their time. And maybe it works one time. Maybe you put $100 down and it turns into $1,000. Maybe you do that one time. Can you do that every day? Can you do that for 5 years? Can you do that for 10 years? Can you do that for 20 years? Any strategy you do has to be sustainable over the long term. And not take all of your time and effort. That's why you can see here in this GIF. How many seconds is it? 6 seconds, 7 seconds, 8 seconds, 10 seconds, 11 seconds. 11 seconds, that's all it takes. Hey everybody, looks like we got 5 or 6 people in the chat here today. Definitely, I was surprised. When I streamed on Friday night, I thought it would have the view counts of today, but actually there was a ton of people on Friday night, which is weird. I guess you guys don't have Friday night plans a lot, do you? Whereas Tuesday night, you guys are wiped out from work. You're too tired. I've got work tomorrow! Good stuff. So, we're back here on stockanalysis.com. I made some changes. I made the background black. Let me turn off my music here. There we go. I made the background dark so it doesn't burn out your eyes. And let's get started on some viewer stock picks. Alright. Alright. Okay, so I asked a few days ago on my Telegram journal, I said, write the tickers of the stocks you're following right now. I'll do free financial analysis reviews on my channel. Well, I'll just review them, but again, there are no recommendations coming with this. I guess I should start... I'll start from last to first. Bitcoin, I'm not going to review. It's not a stock. So we have Andrew here. He's got Disney, CPNG, and Baba. Now, what did I say about this guy? I replied to all of these. CPNG, BTI. No, that's not it. Here it is. These are normie stocks. That's not necessarily a bad thing, but you're pretty much constructing a backdoor ETF if this is what you're invested in. Coupang is pretty much Amazon with slightly worse margins, but on the bright side, they're growing the revenue faster. Okay, let's take a look. I don't know a ton about Disney. I did look at Coupang before this, and I did not look at Baba, so I'm going in half blind here. Keep that in mind. Okay, let's look at Disney. This has a lot of controversy. They're woke. They're woke. Let's see if that actually affects their bottom line. Should be interesting to see. Hang on, getting a text message as usual. 1 second. I'm like somebody who texts on the first date, right? Alright, 5-year chart. What? That can't be right. It's lost money for its subscribers. Maybe the going woke thing has made it go broke. Okay, interesting. I haven't looked at it, so I thought the opposite would be true. 42,000%. Wow, but since like 1962. Well, 25% over 5 years. That's pretty bad. Let's just compare that to the S&P 500 over 5 years. 52% positive. That is abysmal. That is abysmal. Wow. Well, there's definitely got to be a reason for this happening. I assume I don't need to explain what Disney does. I think everybody's familiar with it. They have no dividend. I guess they cut it. I think they cut it during Corona. Interesting. Let's see 1 year. Yeah, 24% on the year. How about S&P 500? Oh, this guy, if he has a thesis for Disney, I'd love to hear it because there's something happening here. All it's done over the past 5 years, like Stockmo and Jeremy's picks, is just delivered losses for its investors. Let's take a look. Let's go to TTM. So 2020 was a slight loss, but by Corona standards, that's not a terrible loss. 2017 too. I guess like maybe some movie flopped or something. I don't know. These revenue growth rates are good. Let's see. Yeah, it's still increasing. Let's see. Their cost of revenue is also increasing. 59, almost 60 billion out of 86. What's the ratio on that? Hang on. Gonna bring my calculator up. There we go. Let's see. 69 divided by 87. That's 80% on their cost of revenue. That's a pretty high ratio there. Not good, but there is a positive gross profit. Oh, it's mostly flat. Okay, that's not a good sign. Selling, general, and admin has dramatically increased the past few years. Usually when that happens, I interpret that as a sign that insiders and just employees are, how do I say it? They're coasting and they're just looting the company. Operating expenses are dramatically going up, but they do manage to have a... Oh, wow, their operating income is dramatically falling. We'll have to figure out the reason for this. That's not good. Let's see, are these other operating expenses? Company's fixed costs that incurs as its ongoing business operations. These are going down, that's good. Or that's the operating income, never mind. These are going up and that's going down. Okay, so something's happening here with their operations. It looks like it's slipping out of their hands and they don't know how to run the company. Or at least less than they used to be. Yeah, the last time they had a normal year, like this is the year I expect them to get, was 2018. I guess, when did Avengers Endgame come out? Hang on. Curious about that. Avengers Endgame release date. Guess I should switch to full screen when I'm doing that. 2019. 2019, and this is what they did? In 2019? Okay, well, that's their gross profit. Let's see, net income 2019. Okay, they did manage to have an net income. What's going on there? Oh, income tax? I guess they had tax rebates. Interesting. Oh, no, that's a loss. Okay. So they did have positive pre-tax income. Okay. Oh, yeah, so literally Endgame was the peak right there, 2019. Some of that would have bled into 2020. Then Corona hit, and they just haven't recovered since then. I wonder what the reason for that is. People not going to theaters or what? I'm not sure. Let's see about shares outstanding. Okay, it looks like, are they doing repurchases? Oh, they were doing repurchases up through 2019. Then they started diluting, though. They've held it steady the past 4 years. Okay. Let's see. Their gross margin is frankly awesome, 32%. I'm surprised in their cost of revenue being so high. That is an awesome gross margin, and it looks like it's been... Oh, but it's declining. Still, they've held it steady since like about the past 4 years, but it's definitely dropped. Yeah, 2019, 2018 seems to be like the peak of Disney there. We'll have to see that if there's like any indication, like there's any sign on these stats that point to a turnaround. Profit margins. Wow, they've always had pretty nasty profit and operating margins, but it was 15% and 21% 2018, 2019. Yeah. Yeah, it definitely looks like you can't just blame this on Corona because a lot of these things were dropping even 2018 to 2019. Well, the only way to find out what was happening for sure is you'd have to segment it out and look at it on the SEC filings. All right, so they've had a pretty nasty past 4 years. Let's check out their balance sheet here. 11 on cash and equivalents. Current assets 30. Current liabilities 28. Oh, their debt is creeping up. Let's see their current assets. And this is creeping down. Yeah, their current assets and current debts, they're creeping to intersect each other right there. Let's see long-term liabilities 73. Long-term assets. Okay, so long-term the debt situation is not bad, just short-term. Okay, cash is declining. Let's see shareholders' equity. I doubt it's in the negatives. Okay, it's going up. Okay. That's a good sign. All right, let's check out their cash flows. Yeah, I'm very curious to see what they've done, how they've coped with going from $11 billion in net income to negative 2.8 and 3.1 at the highest. 2021 was the peak. Yeah, this year looks like it's even worse. Or sorry, 2022. Operating cash flows. Okay, they've managed to hold it steady. Okay, but it definitely dropped. Like I said, 2018, 2019 was a nasty year for them. Even with Endgame, interesting. Operating cash flow, positive. Okay. Looks like they're holding steady on capital expenditures. There's no problems there. They're still trying on their business. They made a huge acquisition in 2019 and haven't done anything since then. Investing cash flow. Buying and selling investments in long-term assets. Okay, so they've been buying long-term assets still steady. Looks like they're trying to buy things to get out of this rut here. Financing cash flow. Looks like they're just they're just paying down debt. They're not really getting money from debt or share issuances here. That's not necessarily a bad thing. Free cash flow. Okay, it's more or less in line with the income. So it doesn't look like they're dramatically killing themselves here on their cash flows. Let me look one more time at the operating cash flows. Yeah, this is a lot better than I expected. So if I had to give a prognosis here, I don't think it's the revenue's fault. Yeah, it's got to be the cost of revenue. Let's see, 59 billion. Let me look at the ratios before. 32 to 59. 54 versus 59 on 87. 79. Okay. Yeah, 67 to 79. The ratio to the cost of the revenue has gone up dramatically. So if I had to guess, that's part of it. Let's see here. Interest expense. Oh, okay. I figured it out. Yeah. Interest expense went from 385 million to 1.29 billion. I mean, like, it's not terrible on their gross revenue. Let's say 1298 divided by 87,000. It's only 1% though. Interesting. Free cash flows down. Yeah, I mean, looking at this, I wouldn't buy it. There are some people that they see this kind of thing and they think, oh, this is a turnaround waiting to happen. And this does happen in the blue chips a lot. They have a few years that's a rut. And then, for all we know, there's going to be a documentary in 5 years that talks about, oh, the new CEO, the turnaround of Disney. Though I know their old CEO, I think it's Bob Iger, returned. So it's not like they have new blood in there necessarily. I'm not really amazed by these properties here. ABC, ESPN, Freeform, FX, Fox, Nat Geo, Star. If I had to guess, this just has to do with like streaming just being absolutely crushed. Let me look at Netflix for comparison. Netflix is like the Disney direct competitor. Yeah, Netflix isn't doing so hot either. I mean, it's not negative 25%, but only 8% on 5 years. Oh, 64% the last year. Okay, so Netflix isn't getting hit quite as hard as Disney. Interesting. Their cost to revenue ratio is a lot better. And that was pretty wicked, awful revenue growth there. Oh, okay. Yeah, it looks like Netflix is doing better than Disney, which is interesting. You know, it's funny. I look at all this and I still can't figure out what the problem is. That's usually there's something about it that jumps out here. This is just a weird company. It's really weird. How do you have it where you manage to grow your revenues like this? Even like 2020 didn't like dramatically annihilate them. It was only 6% down. And their cost of revenue didn't increase dramatically either between those years. Just only in the final years right here, it's really spiked up. Yeah, these are a lot of operating expenses though. Oh, it's other operating expenses. Expenses that don't fit into SG&A and R&D categories. Yeah, okay, yeah, going from 5 to 11 billion, 8 billion that year. Okay, so it looks like they had these huge one-time charges, probably carrying it over on that. They have a ton of interest expense. Yeah, that's wow, they're getting really hit hard on their debt. Okay, so I think that has to do with it. I think that's just they have these weird operating expenses and they're just getting hit hard with income and interest expense, but even still, that's not like it's only 1% on their revenue. Very weird. Huh. Yeah, I don't have much thoughts on this. I'm not going to dwell on it because I'm not taking away anything from it. We'll check out Coupang though. That one I do have thoughts on. I'll bring up Amazon for comparison. So, a lot of people don't know about this. Coupang, it IPO'd recently. I think it IPO'd about a year ago. And this is the South Korean Amazon. So I'll read it out here so you understand. Coupang operates in the e-commerce business through its mobile applications and internet websites primarily in South Korea. The company operates two segments, product commerce and developing offerings. So, all this really means is you can see here it's home goods, decor, apparel, beauty. All this really offers is it's Amazon. Now, they have all kinds of apps also in Korea too, but it's pretty much Amazon. Like I know, for example, too, they do, I think they have a food delivery app, among other things. Yeah, internet retail right here. So the IPO was 2021. I was mistaken. It was 2 years ago. So it's just Amazon with slightly worse statistics. So we'll compare Amazon 1 year. Coupang's up 1% on the year. Amazon's up 11. We'll do 5. Minus 49 versus plus 40 on Amazon. We'll do year to date finally there too. That's about the same as 1 year though. 18 versus 61. Amazon's just overall a better company. I mean, Amazon's operating in the US market. I'd rather have exposure to the US market than just the Korean market. The Korean market has a hard time growing. But anyway, let's take a look at the statistics for Coupang. Okay, so well, these revenue growth rates are definitely better than Amazon, but Amazon is a lot more mature than Coupang. It's interesting though, even in 2015, 20% growth rate versus 21%, 37% today. There's no sign of any of this stopping. Coupang had a really awesome year though. Yeah, their growth rates are better 2020 and 2021. 2022 wasn't that great though. Cost of revenue is 16. Is it increasing? It is increasing, but then again, so is their revenue. 16 over 22. Let's see what that's like. 72. One thing you'll notice, it's a lot easier to look at trash companies than than these blue chip ones. Like, usually the blue chips have nothing home to write home about. Like, everything's more or less okay. But anyway, 72% on their ratio. And let's see for Amazon. 288 divided by 513. 56. Yeah, so Coupang's cost of revenue to revenue ratio, or their gross margin, I should say, is a lot worse. But not terrible. I've seen worse. Selling, general, and admin 5,000 on 22. 22%. Let's see, Amazon here. 54 and 513. 10.5. Oh, interesting. Yeah, so Coupang's selling, general, and admin ratio is a ton higher than Amazon. Amazon runs their office really lean and mean. That's super cheap. See their interest expense. Okay, their debt obligations are going down, or they are taking in money. Interesting though. Yeah, it's going down. Interesting to say. Wow, with these statistics, With this growth rate, they still have mostly negative years. This year looks like it'll be the first year that's positive. That's fascinating. I had no idea that Coupang loses money. Interesting. Only 415 out of 22 billion. That's pretty bad. Yeah, after taxes it gets worse. Well, at least it's going to profit. Well, if the company is trailing from unprofitability to profitability, that's usually a sign that their PE will expand and the stock price would go up. A lot of people do seem to think that way. Let's go to their margins. Solid gross margin. Okay, their basic business works. That's good. But operating margins and profit margins, not good. Yeah, pretty much 2% on both of them. Again, we were looking at these the other day. These are on par with like these like penny stocks and marijuana stocks and Fubo or whatever. Hey, Get Owned, thanks for coming by. Really appreciate it. We're just looking at viewer stock picks. Appreciate you in the chat here. Right now we're looking at Coupang, which is the South Korean Amazon. And so far, I like that it recently crossed over into profitability. But other than that, they've got some problems. Definitely got a lower... That is so weird that they... Oh yeah, the cost of revenue takes out so much. Okay, they have to lower their cost of revenue, which is weird because their gross margin's pretty solid. I'd like to see some cut downs here on the ratio between selling, general, and admin. Maybe the cost of revenue, but cutting cost of revenue on a company that's like Amazon is pretty much next to impossible. Yeah, not amazing operating margins and profit margins. Let's see Amazon. Well, actually, it's actually not much better or worse than Amazon itself. Actually, both of these are positive 2% for both. Amazon is 2% and negative 0.5% on this year. Though in previous years, like ignoring this year, yeah, Amazon's in the 6% range. So Amazon has a lot better operating margins and profit margins. They'll have to figure out how to get that under control. That's a huge demerit to me. Making a video right now, but semi-tuned in at the same time. Hey, I appreciate it. Good to see you, Carbonomics. You should have written your stocks. You should have written your stocks and I could have looked at it on the Telegram journal. Okay. Yeah, I see a lot of this stuff and I'm getting really nervous. So let's check out, though, the shares outstanding there. I think there's going to be massive dilution. Oh, that is horrible. Only 29 million issued in 2020. 2021... That is massive dilution 3 straight years in a row. It is a miracle the stock price looks like what it does. That is a miracle. Yeah, only down 50% on that stock dilution. That's one of the worst I've seen. They must be timing it appropriately to get like the maximum amount of revenue and not totally crush their stock price. Well, if that dilution stopped, you could see the stock price go up a lot, but that's brutal. That's some of the worst share dilution I've seen. What does Amazon do? They probably buy back shares if I had to guess. I can't say. Am I blind here? There we go. Yeah, okay, 9.5, 10.1. Okay, so they do very slight minor stock buybacks. Coupang dilutes massively. Let's check out their debt situation. Cash and equivalents. Current liabilities 5.6, cash 4.7, total current assets 6.7, 5.4. Current liabilities doesn't look like it's too terrible. Does not look like it's too terrible. Let's see, long-term liabilities 7.9, long-term assets 3.9. I think I found out why they're diluting massively. 3.9 long-term assets versus, let's see here, 7.9 billion long-term liabilities. That makes me nervous, seeing that much long-term debt on the horizon. That said, if I had to guess, they incurred most of this debt. They probably incurred most of this debt before interest rates went up dramatically. Give me a second. Let me look at the Korean interest rate here. Hopefully they incurred most of this before interest rates went up. So these are the South Korean interest rates. Let's see here. It was... we need to have a longer. Can I get 10 years? That's better. Okay. Well, we can see by looking at their chart here, when did they take in most of their interest? Balance sheet. Let's look at the long-term liabilities. Yeah, not all of this is on the stock market, unfortunately. Because the IPO'd only so late. Yeah, 2019. It's either short term. It looks like a lot of this long term debt. It was taken on pretty much evenly across the past 4 years. With actually, it's more heavy 2022, 2023. All my stocks are micro caps. They don't even go up on that site. Oh man, when will people learn? I think one of my first videos about you literally started with stop buying penny stocks. Stop. Not financial advice. Do what you please. Just watch this GIF. I don't know like how somebody could spend all this time, especially when they're so young, and you can use that time in your brain plasticity to learn new skills, increase your income. All that time looking at the narratives around exciting stocks when you could just buy in 11 seconds and forget it. Think about it. Something to think about. Anyway, let me go back to this debt here. Debt growth. Oh man, it is growing dramatically. Oh, well, I'll just look at the total debt. That's probably the best way to do it rather than looking at long term. All right, it's increasing. And again, most of the emphasis is 2020 to 2023. Let's look at their interest rates. Oh, that's really lucky for them. Okay. It looks like they loaded up on debt late 2019 to 2021. And that interest rate's around 0.5 to 1, especially if it's longer term. It's up to 3.5 now. That's still lower than the US, but obviously if they're primarily operating in the Korean market, we can just throw that out of there. We don't have to take that into account that the interest rate's a little bit better. Yeah, even still. Okay, that makes me feel better though that their long-term debt is mostly in the lower interest rate versus now. They loaded up on it though, and that's really makes me nervous. No, if I wanted to, I could make a financial model to see if they'll take in enough cash. The cash is increasing, though I wonder how much of that's from dilution. If they'll take in enough cash to definitely take care of this long-term debt here, that's making me nervous. 1.9 billion. Well, long-term debt is only... Oh, there's other long-term liabilities and long-term debt. Yeah, I should just look at this together. 2.2. Yeah, they'll have to take on more cash. It's not making me dramatically exciting about this. Like again, it's better than like a, trash like NASDAQ microcap or whatever it is, but by blue chip standards, these are pretty mean margins here and pretty mean levels of debt. I'm a little nervous about this one, to be honest. Okay, interesting though. All right, so the next one he had was Alibaba. I'm not going to pretend to be an expert on this one, but it's good that all these are kind of related. Baba is very similar to Coupang, and it's also very similar to Amazon. So actually, I'm going to compare all three. This will be an interesting exercise. All right, past 1 year, let's say. Flat on the year, down on year to date. Negative 40% on the 5 years. Negative 6% on the 5 years, or on the max. Let's say 5 years, 40. I wonder how much of this is just nervousness over a trade war with China and bad relations with China. That's a pretty wicked 5-year chart. And the funny thing was like, Corona wasn't even really hurting them that hard. They went up during Corona. The peak was 2021. Gee, I wonder what happened 2021. Though interesting, it looks like the Ukraine war also hit them hard too. Okay. Well, anyway, let's see. Revenue growth slowing down, only 1% in 2022. Yeah, okay, 2022 was the peak of revenue, and pretty much the revenue growth halved after 2020. But again, it's not the end of the world. These are still like pretty awesome percentages here. Though maybe people think that it's starting to cap out here. Yeah, the revenue growth is negative 45-degree knife. Gross profits going up. Selling general and admin, they're keeping that under control. I really like to see that. Let me compare that to Amazon again one more time. I have to remember though, Amazon is a really low ratio. Yeah, Amazon's blowing up their selling general and admin, so it looks like Alibaba is doing a better job running it. Let's see the ratio here. 146 over 897. 16. I forgot Amazon's already. This is something I would put on like a spreadsheet or something like that. 54 over 513. We'll do 514. 10.7 versus 16, close, but Amazon has a slight advantage. Okay. R&D. Yeah, none of these, it doesn't look like their operating expenses are going down, or that's good. Yeah, their operating margin looks pretty awesome, to be honest. Yeah, 13%. That's way better than Amazon. Gross margin 37. Amazon is, let's see here. Yeah. Oh, 43. That's better, but they do way better on the operating and profit margins. 13% and 9% versus 2 and 0 for Amazon, though. Amazon before was 5 and 7. I don't know if we can look at that. Well, let's put it this way. I like Baba. Just on the statistics alone, I like Baba more than Amazon, and I like it more than Coupang for sure, but I just, as a rule, I don't invest in anything China. You never know, like, when you're going to wake up one day and suddenly, like, there's, like, a Taiwan invasion or something, and your investments are done, and they get sanctioned like China or something else. Like, I know, like, it's a whole can of worms opening the geopolitical thing, but yeah, just as a rule, I don't invest in China. Though, if I had to invest in China, this would probably be the only company I would do. Okay, so yeah, really nice, awesome gross margins, good profit margins, good operating margins. Looks great so far, yeah. I don't see too many things to complain about. Let me see their shares outstanding. Yeah, no dilution either. Looks like they're slightly buying back shares, really good. Though, if I had to remember, Alibaba, I think, is like literally a piece of paper in like a safety deposit box, and that's how it's on the US stock market. Again, I just wouldn't buy a Chinese stock on the US stock market. Anyway, 1 minute break before we go to the balance sheet and cash flows. Gonna take a water break. Okay, I'm back. Gee, it's hard to do fasting and do live streaming at the same time. Not that anybody cares. Yeah, I kind of learned last stream I was talking way too much about myself. I was watching a replay of a guy's live stream playing a game I like, and it's FTL, and I just wanted to see the gameplay, and he kept talking about himself and like doing chitter chatter, and I realized, nah, nobody wants to watch that on live streams, so I'll try to keep that in mind too. Anyway, Alibaba, let's check out the balance sheet. Wow. Okay, 544 cash and cash equivalents. Let's see their current liabilities, 380. Yeah, their cash isn't alone enough to cover it, but their cash and cash equivalents are, even ignoring receivables, 730 versus total current assets versus current liabilities 380. That's awesome. Let's see, long-term liabilities 249. That's even better. Long-term assets. Oh my goodness, this is a fortress balance sheet. You see here, billion. Sorry, that's like almost a trillion right here. I mean, yeah, forget it. This is in millions, and this is this is in millions, and there's a million right here. So long-term assets going up dramatically, cash and cash equivalents going up dramatically, and yeah, they outnumber their debt here like 3-1, 4-1. I'm not concerned at all about this debt. Yeah, and it's going up too. It's not like they're drawing down on their assets. Let's see their liabilities. Current liabilities flat, awesome. Okay. Long-term liabilities also going up, but kind of flat too. Now, obviously, you should take on debt if you want to grow, but that's like wicked amazing. Maybe they halted it when interest rates have started to go up. Yeah, debt growth. Let's see here. Yeah, it's just trading up and down. That explains why it's flat. Total debt here. Okay, going up ever so slightly. 165 billion. Let's see, total assets here. That is over $1 trillion in assets. Yeah, forget it. Yeah, this is a fortress balance sheet. There's very few things I say that for, but this is a fortress balance sheet. Compare that to, forgetting couponing even, let's compare that to Amazon. 462 billion total assets, let's see. Total debt, 316. Okay, that's good, but that's not a fortress like Alibaba. Wow, that's amazing. All right, let's check out cash flow. It's such a shame this is a Chinese company. Such a shame. Share price compensation going down. That's what I love to see. That's what I love to see. Okay. Okay, net income's kind of flat, but still, like, it doesn't matter if a company's mature, right? Operating cash flow going down. That's not good. Okay. Investing also going down. Financing also going down. Okay. Yeah, maybe that's part of the reason for the nervousness in the stock price here. I don't like to see operating cash flows going down. That's the only demerit. But other than that, this company's got, other than this year, I really want to see how 2023 turns out. I'm a little nervous about that. It looks like it's improving though. Other than 2022, they got awesome revenue growth. They do a good job retaining it. Their margins are awesome, better than Amazon. Everything's better, just other than the fact that it's Chinese, other than it's a Chinese company, and because of geopolitical risk, I wouldn't invest in something like this. Yeah, but hey, it looks great though. Yeah, this is something like you'd want to see on a blue chip. This is something you definitely want to see. That's interesting. Okay. I put some text on my screen by accident. I think I just like copy pasted it over. That's funny. All right. Well, then that's all for Andrews here. Yeah, Andrews. Let's check out next. Nathan, BTI, Baki. I don't know BTI. Is that British Tobacco? I'm not sure. BTI, Baki. I know O and 3M. These should be interesting. I don't think I'm able to get through all these today. Yeah, I think I'll go through Nathan's and that'll be the stream. BTI, Baki. I don't know Baki. I know O is Realty Income, the dividend stock, and people are souring on it. I saw on another channel that on the dividend subreddit, they were trashing this thing into oblivion. I think the reason is that CDs are going up so much, you can get like a 5.5% CD, and dividend people, they just want the monthly checks, right? So, yeah, why buy a dividend stock when you can get that? It's probably hurting them a lot, but I'll check it out. It should be interesting. All right, BTI. Let me see what I said about Nathan here. Did they even reply to him? You like dividends, why buy these over an ETF like SCHD? Better yet, why do dividends at all over something like VT or VU? I'm not going to get into dividends, but you know, safe to say that it's psychologically superior to all other strategies, but it is structurally inefficient. So dividend stocks, I've said this many times, dividend investors outperform almost all other categories, but it's structurally inefficient. So if you were actually to perfectly adhere to other investing, like ETF investing, like broad index, not dividends, you would do better. But the problem is dividend investors, man, they're incentivized to buy and hold, and that's why they do so well. They just hold and collect and collect and collect. Because at the end of the day, the only thing that really matters so far, at least up until the current day, it seems like has been time in the market. Because dividend investing makes it like psychologically really appealing to do that. They tend to hold longer and they tend to win. Not because their strategy is superior, but just because it's an entertaining game and they hold longer than everybody else. Anyway, let's go to BTI. Should be interesting. Now, for all these, I'm going to be comparing to SCHD. And also, I'm going to be comparing to VTI. Those are going to be my benchmarks. I see here a comment. Let's read it. I figured the dividend investors would sour on the strategy in general. I wonder what the hatred specifically for O is for. Well, we can find that. I'll bring it up on the Discord. That should be interesting to see. Yeah, I am curious to see too. You know, yeah, in the interest of time, let's just go to O directly. See what's going on here. And also, I'll bring up the Reddit. Hang on. Stand by. Sorry about that, everybody. That's even better. Okay, so anyway, why do people blank on O? For those of you who don't know, O is like the king of monthly dividends, and it's a REIT, meaning it focuses on real estate, specifically triple net leases. Good to see you, Hasina Farms. People love this stock. So anyway, why do people blank on O? So I've seen recently that r/dividends has turned against this stock. My personal theory is that, well, number one, it's probably not doing well, but number two, I think that dividend investors, I think a lot of them are going to CDs. Again, at 5%, you can get monthly payments on it. Dividend investors at the end of the day they don't really like stocks. They like passive income. They like those monthly checks. And if they can get it FDIC insured, a lot of them, not all of them, but a lot of them are likely to go over to CDs. But let's see. Why do people blank on O? Seems pretty solid to me. It's not the best, but I'd say it's consistent. This guy he loves swearing. I've been on the fence about it. I love this. Seems pretty solid to me. I've been on the fence about it. This is why you don't buy individual stocks. Really, everybody is so irrational, even in his post. Seems pretty solid to me, but I'm on the fence. Let's see. Everyone hates on every company when the stock price drops and then cheers when it rises. This is how it goes. Yeah, that's true. So that's why you buy a broad ETF. Well, it's not really helpful, though, because they can't hold for 10 years. They just want for a week. So this is just blaming everybody, okay? Who doesn't like O? It's fashionable to blank on REITs and banks these days. It's fashionable. Okay, they just think it's fashionable. That's not an explanation of why. Yeah, again, people can't even, like, they can't even describe or figure out what's going on with Reddit behavior. What makes them think they can figure out what's going on with investor behavior and stock market behavior? Everybody on here is clueless. Here, finally, it looks like a useful answer. Every company in the real estate sector is facing strong headwinds. Commercial real estate is under strong downward pressure post-COVID. Well, we'll see. It might be true, but we'll have to look at the statistics to see that. A lot of people are working remotely in office properties. They're seeing vacancies too high. Tenants have been difficulty making lease payments. I'm not really sold on that. It's popular. The hypothesis that seems to be the case is that expendable income for millions is about to go down. Big time loans are coming back and no end in sight. Well, we'll see about that. We'll have to verify it. Yeah, all this is just talking about like hybrid work, remote work. It hasn't performed well. It's a tough time for REITs. Finally, somebody agrees with me. Okay. It's a tough time for REITs at the moment, especially with CDs and T-bills pushing over 5%. Why would someone buy O when other options that yield 5% with practically no risk? Just a thought, speaking in the short term here. O and others would need a higher yield to become more competitive in the current economic environment. You think they'd have to increase their revenue or something else, but no, they got to raise their dividend yield to be competitive, right? I guess for dividend investors, it would be. Let's see here. The downside to those CDs and T-bills is that bonds all have a shelf life. When done, you're probably not going to get those same rates, but with O, you're going to get that return far and long past those shorter duration investments. CDs and T-bills have a short shelf life. Hang on 1 second. This is ridiculous. These people have no idea what they're talking about. Hang on. Let's see here. Back to screen recording. Here I am on bankrate.com. This is 10-year CDs. You can get 10, 7, 5 years, I think even up to 20-year CDs, and T-bills are even longer. Maybe not CDs, but everything else like that. You know, it's, yeah, there's term lengths you can look in here, maximum 6 years. You can get super long-term CDs. In fact, I just saw on Twitter the other day, Fidelity was selling them in the 5.5% range in 5 to 10 years. So, no, that's just not true at all. I understand why he has a downvote. 20-year treasuries are yielding 4.5. Plenty of shelf life for me, and I can sell out of the money SPY puts to juice up to 8%. Yeah, and that's the thing. When your CD ends, you can just go back to O. Like, the stock price reflects now in the immediate future. And if you got a CD, okay, wait for it to expire, then just go right back. You are so wrong that it hurts to read. Like, wow. So instead of a bond that's principal protected, you should buy a REIT that's diluting shares and selling them? Oh, I'm sorry. He agrees. Yeah, he disagrees with this guy. Okay, I shouldn't have read it in the mocking voice. You were so wrong that it hurts to read. Like, wow. So instead of a bond that is principal protected, you should buy a REIT that is diluting shares and selling them, lowering the price constantly in order to pay a dividend. It is already nearing a 300% payout ratio. Well, most dividend stocks have that, especially on REITs. REITs naturally have higher payout ratios because they're required by law to pay out 90% of their funds from operations. What happens to their shareholders and dividends? What happens when they cut the dividend inevitably and the share price drops even more? What if they end up like MPW? T-bills yielding 5.5% in 30 years at 40% lol. Yeah, that's it. That's what I thought it would be. Everybody else would be, well, everybody's just sour and mean and angry. This is the real reason. I think it's just losing out hard to CDs and T-bills. Okay. I don't think we need to look at the rest of them. I don't think we need to look at the rest of them directly. Let's just look at the actual statistics for O. Okay. This is a game you have to play with this website. You keep clicking until it loads. Oh, -15% on the year. -50% on the year. Again, that was YTD versus year. -3% on 5 years. Up a lot maximum. Okay, but pretty much this thing has been flat since 2015. It's been paying out a dividend. It's very easy for REITs to be that way because they pay out dividends. But yeah, before this, they were doing wicked amazing. Being a REIT and also growing at this rate. But yeah, I'm not psyched at flat on 5 years. Let's see SCHD. Up 37%, almost 40% on 5 years. VTI. Let's see here. 46% on 5 years. Yeah, this isn't doing too hot. Not doing amazing. -15% on the year. +3 on the year for SCHD, which is the dividend ETF. VTI is 13% on the year, and that's the total stock market. Yeah, not doing amazing. Well, let's see what's actually happening here. Revenue's going up. Okay, but again, that doesn't tell us a ton. That's a really good sign. I mean, they really blew it up in 2022 and 2023. Definitely, the real estate market has been a landlord's a landlord's dream ever since all the spare inventory got bought up by huge banks and mega firms. It's definitely been a landlord's market here for real estate. Glad I got into it. Cost of revenue is growing up with it, but again, if you see a dramatic increase here, we should just compare the ratio. So current day ratio 286 divided by 3690. That's that can't be right. 7% on their cost of revenue. That is wicked amazing. Yeah, 90% gross margin. Of course, because it's a REIT, right? Obviously, we really need to care about the operating margins and profit margins. That is wicked amazing. Amazing revenue growth too. I know that bombshell is going to be dropping here soon, but I don't see it yet. That is wicked amazing. But let me just compare to the past here. I'll just do 2019. Cost of revenue here, 66 over 1328. Four. Okay, it's increased, but not a ton. I guess like the rate of increase is what's important though. For a REIT, they'll have to compare this to other REITs. I'm not sure if that's good or bad. Gross profits going up. Selling and general admin's also going up, but again, if you're doing more work, that's not necessarily terrible. Operating income's going up and it's still massively positive. They have some interest expense, not terrible. Again, it's offset by previous years. Net income, it was flat before, it's gone up dramatically. They've actually had a really wicked awesome last year. But then why is it down 15% on the year? Shares outstanding. Oh, mega dilution. Okay. So if I had to guess, if they suddenly do mega dilution, they probably had some terrible debt event, or they want to expand dramatically, or something happened, or they're paying for a previous year. But I don't see, looking at even at 2020, yeah, unless they're paying for these two awful years, I don't see it. It wouldn't justify all that debt expansion. But maybe they did. Maybe they did have to take on a ton of debt. I'll have to check on that soon here. Gross margin is amazing, but it's a REIT. Again, let me just compare it to another REIT. Let's see. I'll compare it to a REIT I like. I used to have land. Let's see. So we can get an idea what's happening here. This is a farmland REIT. Or sorry, a farmland REIT, I should say. Okay, the gross margin is slightly lower. Operating margin, slightly lower. Profit margin, -16. Okay, so by REIT standards, this is pretty good margins here. This is just a run-of-the-mill farmland REIT. Okay. Not too bad. Let's check out the balance sheet. I think this is where we're going to discover our problem. Let's see their cash. Okay, they raised a ton in 2020, probably from that. Probably from debt, if I had to guess. Okay. That's a bad sign. Looks like they took out a ton of debt. 824 million. 2020. This is probably what's happening here. Okay. Total assets, 53918. Total liabilities, 220. Okay. That's weird. Okay. So they did. They took out huge debt 2022, 2021. But their total debt versus, let's see, even their cash, they can pay. Yeah, their debt's not terrible. I don't understand what's going on here. Interesting. Cash flows maybe? Going up? Yeah, why is this going down? This is a bad sign when I look at it. I can't even see why it's going down. Oh, investing cash flows. They are bleeding out cash. Now we have to figure out why. That is $10 billion bleeding out in investing cash flow. What is happening there? Capital expenditures. What is happening? I hope these are acquisitions, but they're not. I have the acquisitions right here. They're selling acquisitions, which is not a good sign. Obviously, they did a ton in 2021, but capital expenditures are bleeding out. Let's see. Payments for property, plants, and equipment. Cash spent on long-term assets used to run the business. Well, as long as it's staying in the business, it's not like, again, it's not interest payment, it's not debt payments, but that's atrocious. If that were debt, that would be atrocious. They are spending a ton on capital expenditures. Way more. Yeah, I'm shocked they have any cash to begin with. After all that, yeah, it's gone down a ton. I guess they took all this and spent it on capital expenditures. They raised a ton of cash in 2020, and it went straight into capital expenditures now. So let's see how did the cash increase 2020? Let's see how that happened. Yeah, look at that right there. So let's see what caused that though. Well, we'd see that on the cash flow statement, right? Capital expenditures going out, acquisitions going out, investing, let's see. Dividend payments are going up dramatically. Only 5 billion today and 4.4 billion before and issuing shares. So that's not it. Oh, wow, they are paying a ton on debt, 3.4 billion. Let's see their yeah. I found it. Okay, so their gross revenue 3.6 billion today. But let's look at their investing cash flows. They are oh, I'm sorry, they're taking in debt. I'm sorry, really newbie mistake. Okay, they're taking in cash from debt, $5.83 billion. And yeah, they're issuing debt and they're taking in cash from that. So they're not losing it. Okay. So what caused all that cash in 2020 to come in? Guess it was this, yeah, I guess they took on debt, but even still, that's not dramatic. I gotta figure that out. Probably when I watch the replay of the stream, it'll probably be staring me in the face and I'll probably be kicking myself for not figuring it out. Okay. But anyway, they had $824 billion in cash on their balance sheet in 2020. So let's see how that happened. Did they 2020 capital expenditures. So they spent same as much before. They didn't sell anything. It's got to be investing cash flow. Yeah, it looks like it was just debt. It's got to be issuing debt. That doesn't explain how much was coming up on there, but it looks like it was just issuing debt. They also issued a ton of debt the year before, too, or they issued a ton of shares. Yeah, it looks like it was a combination of, oh, I found it. Okay, they issued a ton of shares and issued a ton of debt. That's got to be it. But still only comes out to 1692 over 824. Oh, okay, that was it. So they issued a ton of shares and a ton of debt 2020. And that's why. Okay. Should not have taken that long to figure out, gee, during Corona, they issued a ton of shares and diluted and took on a ton of debt. Duh. It should not have taken me that long. That's crazy. Makes me look like a noob. That's why it's a lot easier to look at trash companies. You can just go straight to this top right here. See, okay, let's see their income statement or revenue. Their cost of revenue is going is taking up all the revenue. This company's dead. It's a non-starter, and there's a negative 45-degree knife chart. Those are easy to look. It's a lot harder to look at these mega cap companies. Anyway, yeah, so it looks like this is a combination of it looks like they got a pretty wicked, nasty debt situation going on here. They diluted a ton. Again, the payout ratio doesn't matter so much. Like, the dividend is increasing dramatically, but payout ratios have to be pretty high on REITs. Though, obviously, they have to be 90%, not 300s. That's pretty nasty there, but operating cash flows seem fine. Just they're taking a ton of took in a ton of debt there. And they're paying through finance activities here and debt as well. Okay. Yeah, it just looks like it's pretty debt laden here. But let me just compare the balance sheet. Total assets 5398. Shareholders' equity is going up. Total debt 1919632. Okay, yeah, so it looks like a lot of this is psychological, to be honest. I don't see anything too terrible other than they just like spent a ton of money on capital expenditures there. Yeah, I guess people are just nervous about the business generally. Like, they think that remote work is going to kill this thing. Frankly, I don't see it. Revenue's growing fine. They're keeping the cost of revenue down. Income's going in. Yeah, they had a ton of cash sloshing around because they raised a ton in 2020, but it looks like they've deployed it all. Again, I had to verify this to be sure, but it looks like cash flow right here. Yeah, if they're doing capital expenditures, it looks like they're spending their money. So if they took in a ton of money, and at least they're they're spending it on the business, you might see a return on this in the future. This doesn't look terrible at all, to be honest. I don't know why people are so upset with this. I guess other than dividend investors like, yeah, well, forget this 60% revenue growth rate. I want my 5% CD. I guess that's literally it. Yeah, sorry they took on a ton of cash in 2020 to be safe. It was a pretty low interest rate at the time, and they're spending it on the business. I don't see the problem here unless I'm missing something dramatic. I'm hardly an O expert. Sounds like a company that's a slave to the dividend aristocrat title as well. Gotta please the dividend investors. Dividends! Dividends! Copying another channel when I say that, but this doesn't look terrible at all. Their balance sheet looks fine. Revenue's growing. Money's coming in. They had a deluge of cash. They found a place to spend it, which is great. You don't want cash sitting on your balance sheet doing nothing. Am I really, chime in here, chat? Chime in here. Am I missing something? Like, am I looking like a moron? I don't see anything terrible about this. Let me go to why is O tanking. REITs are impacted by a raising rate environment than other industries. You'll see most REITs struggling. Yeah, how could I miss this when I was in land? Yeah, so when interest rates go up, because REITs are so dependent on financing, because if they have to spend out 90% of their funds from operations or their net income, right, to the dividends, what does that leave? Because all of your cash is going out to dividends, you have to, by law, because you're a REIT, you have to raise it on debt. With that said, they had a ton of cash. Let me go back to full screen here. Let me do U.S. interest rates chart. They had a ton of cash they raised during 2020, during Corona, and they spent it all. So, yeah, let me go right here. They raised a ton of money at literally a 0% interest rate, and the market is mad at them. That I guess going forward they're gonna have a problem with that. But they had a war chest of cash there that I think compared to other REITs they don't necessarily have to worry about as much. Let's see right here. But the dividend is over 5%, right? So why would anybody be upset? REITs in general have been getting killed by interest rate. Check out VNQ or VNQI. All right, I'll check those out. Yeah, VNQ, for those of you who don't know, is just the Vanguard real estate ETF. 1 year. Yeah, I guess it's just generally interest rates, but I think compared to other, 9.6, almost 10% down on the year. 15% down on the year. Yeah, maybe there's something I'm sucking about here with my analysis, but they, again, they took on a ton of cash during 2020. That's $824 million. They had a ton of cash on hand, and it looks like they weren't spending it. Capital expenditures. Yeah, they didn't spend it until the last 2 years when the interest rates went up. So, yeah, it looks like they deployed a ton of cash at a wicked awesome interest rate. Yeah, going forward, it might suck. So I guess, like, if they don't want to... I see the problem. So going forward, if they don't raise through debt, because it's over 5%, they will have to dilute. And the rate of dilution has increased. Yeah, so... I think what's happening is investors who were in this 2 years before have paid the penalty. Looking at this now, yeah, I guess this is market. Everything else looks fine, right? The only thing that's concerning is the interest rate, right? Everything else is totally fine with this company. I don't see a problem with it other than it's like a dividend stock, but whatever. Putting that aside, everything is fine except that the interest rate is, as you can see right here, 5%. That's the only problem. If people expect it to maintain this or go up, then yeah, I would be nervous about this company. If interest rates go down, I'd have to think about it, right? There's definitely, you could see a story here. You could see a narrative where this could turn around, especially because like the dividend crowd would come right back. They would call, after being stood up on the date, the dividend crowd would call right back and go right back into the stock. Okay. Yeah, I think half of this is interest rates, and half of this is just narratives, just generally about, oh, real estate's dead. Nobody wants to work in the office anymore, which is not true. Yeah, sure, there's hybrid work, but people are still using offices. You're always going to want to use corporate spaces, especially with O's tenants. It's people like Walgreens and CVS and stuff like that. That's just always going to be there. They position themselves pretty well to take advantage of, or not take advantage, survive the fact that a lot of things are going remote now. Yeah, I don't see anything too terrible about this company other than the narrative around that. So it just seems like it's spooked investors. And also they realized at 5% interest rates, well, if they're not going to use debt anymore, they're going for us. That said, though, they had a ton of cash, so that definitely should have softened the blow. I guess, what's another REIT I can compare this to? Let me think. Do you guys know another REIT? If I had to guess, O has gone down less than other REITs. So there's O. What's another major REIT? I should know these. Preferably not one that's like gas pipelines or anything like that. I guess I could just search REIT, right? ADC. Thank you. Yeah, of course that one. Of course. Thank you. So let's see. Last year, 18%. Okay. So this is bearing out. The market is reacting like how I expected it to. ADC did worse last year than O, and that's because I think O honestly had a lot better cash situation and balance sheet. Let's check out their financials. Oh yeah, they only 20. So they didn't have a massive raise during 2022. They just bled their cash reserves rather than raising. And yeah. So they had a lot worse of a cash situation, and they're just drawing it down now. Okay, let's check out the how much they're issuing shares. If I had to guess, they're just issuing more. Aha, I found it. So they issued shares rather than taking on cash. So O made the right play during 2020 by taking on a ton of debt. This looks like this company is trying to be more have more austerity, just draw down the cash and not try to penalize and take on debt. But instead they penalize their investors through dilution. They paid the price. Okay, interesting. ARR, Armor Residential REIT. Okay. This looks bad. Negative. Oh, this is atrocious. Mostly negative revenue. Check out their balance sheet. Cash is drawing down. If I had to guess, this is a wicked, nasty chart here. But people probably like it because the dividend, right? It's got a 20% dividend! It's got 20%! Dividend investors, man. 20% dividend! Negative 25% on the year. Oh, negative 45-degree knife chart. Oh, 100% knife chart. This is atrocious. Mortgage-backed securities. That would be it. Okay. Mortgage-backed securities. Well, man, what do you have to say? Okay, anyway, NTSC, or NTST. Open up one more. We're going down a REIT rabbit hole. Good thing I have so much experience investing with REITs through land. Okay, 4.84% dividend. That looks a little bit more reasonable. Down 12% on the year. A little bit less than O. 5 years, 5%, or almost 6%. Revenue's going up. This is a pretty young company. Interesting. They're growing their revenue pretty wickedly awesome. That's good. See their margins here. Margins are... Let's see. Go back to Realty. 90, 40, 20. 80, 16, 4. So margins are slightly worse. Okay. But if I had to guess, this revenue growth is a lot better than O. Obviously, it's not as mature. What's the market cap? Oh, it's only $1 billion market cap. This is an interesting one, though. Let's see. Internally managed real estate trust based in Dallas. Single tenant net lease properties. E-commerce resistant tenants. Okay, so they're trying to do the same thing as O. They're just smaller. Oh, but it's more startup. This is not looking too bad. I'm kind of liking this so far. Let's see their debt situation though. Assets 1.7 billion. Let's see their cash and equivalents. That's a lot of debt though. Almost half their market cap's in debt. $500 million. That's not good. Total debt. It's definitely, well, they're drawing down. They grew it a lot in 2022, but drawing down. Okay, I'm a little nervous about that debt. Especially they only have $13 million on $500 million. Yeah, they don't even have enough cash on there for their accounts payable. Yeah, I guess they're playing it fast and loose. They're really doing it risky style because they're trying to grow. But that debt makes me nervous. Okay, let's see the cash flow here. Share-based compensation is kind of a high, definitely a high ratio there. I hope the insiders aren't looting it. Oh yeah, just as I thought, a lot's going into capital expenditures. They paid a dividend. It's a hard game to play when you're paying a dividend. It's pretty high, 4.8%, and also trying to grow at this rate. Yeah. Oh man, they issued $248 million in debt in 2022. Hopefully that's enough to take care of it. But it's not though. I looked at the balance sheet. Yeah, their balance sheet's pretty cutting it close there on these debt levels. Okay, other than the debt, which again, they could probably just pay for it by diluting. Yeah, they're still at $16. They could probably just hit their shareholders harder and dilute for a little bit and take care of this, but that's That makes me nervous. Total debt, yeah. Accounts payable, total liabilities. Their total debt, yeah, grew 100% last year. Their total debt is half their market cap. Let's see the shareholders' equity. It is amazing they're still they're still in the positive right here. Yeah, that makes me nervous. But other than that, looks like an interesting company. We got so off track though. We were looking at realty here. But anyway, as I was saying before, again, other than the narrative of that going forward, they might have a hard time raising money through debt, so they'll have to issue shares. Other than that, and also the e-commerce thing, other than that narrative, this doesn't look like it's a terrible company. A lot of this, I think, has to do with investor psychology. And all things considered, considering there's like a cataclysmic, dramatic, super high increase in the interest rate in a very short period of time with almost no time to react, going down 14, almost 15% is pretty good, all things considered, when the main driver of their business gets taken away overnight. Weathered this storm a lot better than a lot of other companies. And let's put this into perspective here too. Like for the most part, like 1990 to 2001, the interest rate was well above 6%. Even during a lot of the 2000s before 2010, guess what? It was really high above 6%. Let's look at realty income here. They did just fine during those environments too as well. See, in the 90s they went from 7. I know it's obviously adjusted, but from the 90s they went from $8 to 27. Yeah, I think investors who were invested during low interest rate environments, they're getting punished really hard for being invested at the wrong time. But going forward, this company has operated just fine in high interest rate environments. Except for right here, right? So let's look at the interest rate. The interest rate was raised, it looks like 2004 to 2007 or so. It went up super fast. And people who were invested before that got penalized really hard, 2007 to 2009. They got hit hard, $26 down to 16. But after that, so it's hard to compare though, because the interest rate stayed low after that and then grew super fast, super hard. So I guess a better way to compare it would be the 90s. Okay, so let's look at this again. Our chart starts in 1994, which was a low interest rate. Okay, this is perfect. So right here, the interest rate was relatively low. It looks like it was at 2 to 3%. And they raised it to about 6 or 7%. During that time, okay, so they went down slightly, $12 down to 10. But then during a relatively stable high interest rate environment, they grew just fine. Let's see, let's go to 98 to 2001. Yeah, so they went from, they're flat on that time, but they paid a dividend, I assume, during that time. Looks like they were flat, 97.11 to 2001, 11 to 13, so that slowed down growth. Okay, so this looks like it's pricing in slowed down growth because obviously they had a bonanza during low interest rate environments. They bought up everything, but if I had to guess, this is just investors being penalized for being at the wrong time and interest rates going up so fast. Looking at the precedent of the 90s and 2000s, this stock is not dead. By no means is this thing dead. The balance sheet is fine. The revenue growth is fine. They can handle the debt. They've deployed it pretty well. At least I hope so. They did a ton of capital expenditures. They deployed the cash they were just sitting on from 2020. Doesn't look terrible. Yeah, it just looks like the market has adjusted its expectations that, okay, the 2010s are over. It's going to be more like the 90s. Okay, fine. And also, we need to penalize investors who are in there at the wrong time. Okay, yeah, it doesn't look terrible. But, dividend investors, they want their monthly income, so they're in T-bills and CDs, I guess. Neither of those picks are mine. I was just giving you examples to compare to O. Okay, thank you so much, Atlas. I was worried there for a second, but yeah, those are pretty good comparisons. You really helped out the stream there. I was struggling to think of it. All right, so that's O. Yeah. I think you're just betting against the dividend market right there. All right, so next up, I'll look at one more, then we'll go. I am curious what BTI is. British American Tobacco. This guy loves his dividends. 8% dividends. That's way too high. Way too high. Though they're obviously less exposed to interest rates, which probably is better for them, but you're in a shrinking market. Oh yeah, they're down same on the year as O. Okay, and they don't have to pay out all their money in dividends like O does. Down 30% in the 5 years. If I had to guess, pretty flat. Yeah, their peak was 2017. Oh, yeah. Their revenue growth is over. It's been declining ever since 2017. Geez, what happened in 2017? Was it vapes becoming super popular? Now, if I had to guess, this company might have pivoted into vapes, but they're probably behind because Juul does that mainly. Yeah, revenue growth is slowing down. They had a really awesome year in 2017. 6 million. All right, it's gone up a little bit, but pretty flat the last 6 years. Margins are fine. Okay. If only they could grow their revenue, but yeah, the margins are great. They just can't grow their revenue. This is an awesome business to be in if people still smoked. But they don't, so that's the problem. It's the product itself. But on the product itself, these are amazing margins. You don't see margins like this in many industries. 80, 40, 30 gross operating profit. Let's see the share dilution. Yeah, no dilution. This is awesome to see. Yeah, this would be an amazing company if just it wasn't in cigarettes. It wasn't in tobacco and smoking. Such a shame. Yeah, if only these if only these statistics were in another type of business. All right, so current assets 15, current liabilities 16. That's not good. If I had to guess, the debt is creeping up. Long-term assets 130. Long-term liabilities 57. Okay, so they have a short-term debt situation. Long-term debt looks fine. Let's see. Is there a current? Okay, debt's more or less stable. I was hoping there'd be like a total debt. Here it is, total debt. The total debt itself is going down. Are they paying down the long-term liabilities? Oh, so it looks like they're switching. So their current liabilities and current debt is staying the same. Oh, actually, no, current debt is creeping up. Okay. Long-term debt is going down. So they're shifting long-term to short-term. They're paying down long-term, increasing short-term. Let's check out the balance sheet, though, in total. Current assets, 15. Current liabilities, 16. Long-term liabilities, 57. Long-term assets, 130. Okay, yeah. Balance sheet, not great, not terrible. Let's see the cash flow. Operating cash flow going down. Even with those margins, it should not be going down like this. That's a bad sign. Especially in a business like this, when the business itself is having trouble, I'd like to see more acquisitions. They made a mega acquisition in 2017. I'm curious to see what that was, but pretty much nothing since then. They've been selling acquisitions. They sold acquisitions net 2018, 2019, 2020, and 2021. They did minor acquisitions 2022 and 2023. Not great. I'd like to see more. Capital expenditures are going down. Means they're not finding things to spend their money on. But the dividends are... Oh, this is what's probably upsetting people. They are forced to increase their dividends when they're figuring things out. They haven't figured out things and they've frozen their dividends. That probably is making dividend investors upset. It's probably putting downward pressure on the stock. Okay. Looks like they're losing cash flow to pay debt, but it's not terrible. Same thing with investing. Okay. But their operating cash flows... Oh, here's the problem. Yeah, their operating cash flows only just barely counter the financing cash flows right here, which means that they're doing dividend payments, issuing shares. Yeah, they're losing money to debt and share and dividends, and the free cash flow is still positive, but that's a big blow to it right there. Okay. Yeah, so I think it's just the market reacting negatively to the fact that, revenues are flat and declining. Their operating cash flows are going down. And despite the fact that they have these amazing margins, this business is dying. There's pressure from e-cigarettes, vaping. I hope they did an acquisition in this space. I'd have to look. And just the industry itself has a lot of downward pressure. Okay, yeah. Looks like this is all just investor nervousness. Especially if they're frozen. If they've frozen their dividend the last few years, yeah. And you can see the stock price went down dramatically, 40 down to 33. That probably upset their dividend investors a ton. If it weren't in this industry, this is something I would look at. Me personally, this is something I would have bought like a few years ago. Not now, as I exclusively do ETF investing, but man, these are amazing margins, and it's not even a REIT. Such a shame. Okay, we'll do one more, and then we'll do Q&A here, and then wind down the stream. I am curious what Baki is. This guy loves dividends. It's funny, I talk about dividends and the viewers on my stream double. It's just so popular, dividend investing. Did he mistype it? There's no Baki. Such a shame. Such a shame. Okay, well, we'll do Q&A. Write any tickers if you want me to look at them. I'll look at them really quickly. Not as much as the ones on the stream, because I want to prioritize people who are active on my Telegram. Join up the Telegram. A lot of financing, investing content on there, and obviously you get more attention on live streams. I wanted to prioritize those people, but if you have tickers you want me to look at, I'll take a look. And then we'll wind down the stream. This is a tragedy. Too bad it's like a sin stock. Amazing, amazing margins. MFG. Okay. Is that manufacturing? Mizuho Financial Group. Is this Japanese? Aha, I knew it. Together with its subsidiaries, banking, trust, and securities and business related to financial services in Japan. So banks, okay. Now we have to remember, banks have been hit pretty hard. They had a really dramatic interest rate increase. We'll do JP Morgan for comparison here. So banks do well when interest rates rise really quickly, but over the long term, higher interest rates are hard for them. Whoa, JP Morgan's had an awesome year. Let me do another one. We'll do Wells Fargo. I want to make sure that's not like a fluke. Oh yeah, Wells Fargo's flat on the year and down on 5 years. Okay, so we have one that's dramatically up and one that's dramatically down. JP Morgan's always been a good stock. I've owned that at one point too. All right, so let's see. 1 year for MFG. 55%. Okay, something's happening here. It's got a dividend. Do you have this because you're a dividend investor? I see you're 3.36. Okay, but flat on 5 years. Let's see Wells Fargo. Down on 5 years. JP Morgan up massively in 5 years. Okay. So they had a really awesome last year. If not for this last year, that's distorting it. Okay. Wow, 30%. They grew their revenue dramatically the last year. Increased to TTM here. All right, so what's going on here? Let's see this business. 100% gross margin. Okay, that's I guess it literally costs nothing, right? Because it's just all money. Interesting. Operating margins are pretty low, 3% and a negative profit margin. They've had a negative profit margin the last 3 years. Let me compare that to JP Morgan. Yeah, these margins are pretty nasty. So they probably had a good. This looks like it looks like it's one of these hype momentum stocks. I don't know about this long term. It's still early to make a conclusion though. Yeah, JP Morgan's margins are dramatically better. Let's see Wells Fargo. $129.16. Okay, so even Wells Fargo has way better operating and profit margins than this. Okay. Still, that's not necessarily a death sentence. Let's see. Shares. Let's see if they're diluting. No share dilution. Okay. Makes sense. It's a bank. Got no problem to get money coming in. No problem with that. Okay, so again, declining revenues over the long term. Yeah, they had an awesome 2022 and 2023. But declining revenues overall. They're selling in general and admin. That looks like a wicked, awful ratio. It explains the gross margins, only 3%. They spend way too much on running their company right here, especially compared to something like JP Morgan. Yeah, 69 over 128. This is pretty much the same, 1.7 versus 2. Well, let's check out their... Now, this isn't necessarily the end of the world if they have a plan to get out of it. It's entirely possible this has gone up because they announced a plan and the market really likes it for how they're going to get out of it. You might be able to see it from the balance sheet, but also you'd have to check the news around it. Yeah, but declining revenue makes me nervous, especially on a bank. One thing I should check out here is, let me see the Japanese interest rates, what's been happening with this. That might give us a clue to what's going on here. Flat at 0%. Well, that's not the answer. It's not the interest rate. Flat at 0%. Never mind. That's not helping. That's funny. Let's take a look at their debt. Cash and cash equivalents, 67.9. Oh, I'm shocked they have a positive shareholders equity. Now this is in yen, so I need to keep that in mind. But they have a ton of... Okay, so it's the liabilities. They have a ton of accounts payable, which is more or less fine. Their liabilities. You have to check out their debt carefully. It's been growing since 2019. Now, thankfully, their total debt is less than even their cash and cash equivalents. Okay, that's not as bad as I thought it would be. I'd have to take a look at their total liabilities. I'm curious to see what that is. It's not broken out on here. The debt itself is fine. They have enough cash to pay for their debt. That looks fine. So it looks like they've got a... At a quick glance, this site isn't complete. The balance sheet looks fine in here. Usually with this site, out of all these tabs, trust the balance sheet the least. Sometimes like facts and figures aren't like imported in. Doesn't make sense. So discount everything I said on the balance sheet one, especially for something like a bank. Let's see the cash flows. Negative net income cash flow is interesting. Operating cash flow, flat. Yeah, they're mainly taking in money through investing cash flows, which would mean selling investments, okay, and financing cash flows, taking on debt. This is more or less stable, though, too. Okay. Well, let's see. Why are people excited about this? Joins forces with a capital venture. I just see acquisitions here. They scrapped their online bank project. Do they expand into a new market? I don't see. There's no reason on the balance sheet right here that that should explain the increase in price here over the past year. Other than they maybe I guess maybe there was an expectation that their revenue was going to crater. It was a crater pretty hard. Yeah, 2021 was their worst year ever. It looks like, at least in the past, since 2015. Yeah, maybe they saved it here, and that's probably why. Though their 2022 revenue is still lower than their 2020 revenue. Balance sheet looks fine. Cash flows are fine. It's a $3 stock. Oh, interesting. Okay, let me just do the past 5 years. Yeah, okay, so they're in line in 2019. And they managed to save themselves from catastrophe in 2022. Okay, so now I understand. They reversed their bad year and they're in line with how they were in 2019. So that makes sense with everything that I'm seeing. They had a good year. I don't see an expectation of that happening again necessarily. They've got a few years before they get back to 2020 even. They're back in line with 2015. So my feeling on this is that their growth is... I think this is pretty much it. I guess if you like the dividend, fine. I'm not really a big dividend stock, but yeah, looking at this, I think the growth that they would have got is done. I don't see anything else happening here on their income statement that indicates this thing is going to like take off like a rocket. I think they just saved the course there and they just did a correction over the last year for a really bad previous year. All right, so everything on this chart that's happening makes sense, and it looks fairly valued too. They're a huge bank and now they're in the Americas. Okay. You put $10,000 into it. Interesting. All right, so I see here NSA, PFE, and FL. Take a look at FL. That'll be the last one then. So I'm gonna launch my paid topic video service here, and I don't want to give away all this for free. Foot Locker. I like Nike more. I don't even need to read this. If I had to guess. This probably has good margins. Well, that's a really high dividend, 8%, almost 9%. The dividend crowd's going to love Foot Locker. It's interesting they never talk about this one. They talk about O a lot, too. So they had revenue's declining. It has since 2000. It's still higher than 2020 and still higher than 2019. But it is declining the past 3 years. But not, I mean, this is just a fluctuation. It doesn't look terrible. Net income overall is declining though pretty fast. Is there income tax? No, income tax isn't the problem. Operating expenses, I guess their selling and general admin's kind of trailing up. Yeah, interesting. Their operating income is having problems. So it looks like they're not doing a great job running the business. Let's see, shares outstanding. They're buying back shares. That's really good. Okay. Gross margin's awesome. Yeah, this operating margin. I knew it. Okay. Profit margin will ignore that because profit margin is after the operating margin. All right, they were running a 12 to 8 to 9% operating margin, and it fell to 6 and 3. And a lot of this has to do with that they've blown up their selling, general, and admin. Well, their other operating expenses have doubled since 2016, more than doubled, and their selling and general and admin has creeped up from, let's see, 1.5 in 2017 to 1.8 today. Okay, they brought it down over the last year. Yeah, they've run this up, and so they've pretty much taken up all the leeway left by the gross margin, and they've just run it out here on their operating expenses. We'll see more of what's happening on the cash flow statement. Margins, gross margin's fine. It's just these other margins that make me nervous. Okay. If I had to guess, their shareholders' equity is fine. Oh, kind of flat, but not negative. Okay. Better than a Jeremy stock, that's for sure. Yeah, not terrible. Okay. I'm gonna ignore the balance sheet because, like, again, it's really wonky. Just look at on the SEC filings if you have to. Let's see. This one's a lot better usually. Net income declining. That's not good. Go back to the income statement. Yeah, their net income's declining mainly because of their operating stuff. So I'm gonna focus on the operating part of the cash flow statement. Wow, that is bad. That is awful. Negative 37, almost negative 40. Negative 74%. That's, man, what is happening here? It's like they suddenly tripped and hit their head in running their company. Let's see here. Oh, it's not breaking out the operating cash flows though. Oh, I'm sorry, it's right here. Okay. Depreciation, we can ignore that. Share-based compensation. This isn't the culprit. They're holding this steady, 19 million versus 15. That's not the culprit either. Other operating activities. Okay, since 2021, something's happening here. The problem is this is other operating activities are items affecting the cash flow that do not fit into the categories above. This includes changes in accounts payable, receivables, changes in inventory, and various others. So that tells us absolutely nothing. FL is a Jeremy stock, really? Oh, interesting. It's got a high dividend, and the dividend's high.
The dividend's really high. I want my 8%.
Yeah, something's happening here. We'll have to check this out. Last 3 years on their other operating activities, this would be broken down on their SEC filings. Something's happening here to cause them to bleed cash. Yeah, how do your operating cash flow is falling from $1 billion to 91 million in 3 or 4 years. This is horrible. Yeah, they suddenly hit their head and they don't know how to operate their company. And they did fine for years. It might be temporary. Again, I don't know what is causing this yet, but that's not good. Okay. Selling acquisitions, that's a great sign. Offloading acquisitions. I'm curious what their 2021 acquisition was. They did a mega massive one, though. So far, we haven't seen much of a return on that one. Selling investments, that's a great sign. So they're selling investments to pay for this stuff. It's not even a dent in it, though. Okay, yeah, negative 145 investing cash flow. Okay. Yeah, so there you go. What little's left of their operating cash flow is like wiped out just for paying for this investment activity. And then on top of that, oh, here it comes, the dividends paid. They're paying less in dividends, so that might upset some people on here. So even as a dividend stock, it's they're paying less of it, okay? They're really focusing on repurchasing shares. They had to dilute, looks like last year. Oh, this is their first dilution year for share issuance in a long time. That's probably making the stock market angry. Before they were buying. But yeah, with these operating cash flows, I'm not surprised at all they're halting their stock buybacks. That's always great to buy it, right? When a stock is hitting the peak, suddenly their operating margins are going to trash. So they stop their share buybacks, and it's turned a corner, right? To use a Jeremy term, looks like the stock's turned a corner. Yeah, exactly. Okay. Okay, they're starting to, for the first time, they have to pay on debt. Or they're paying down debt. This is so small, you can just ignore it. Yeah, it's a nasty financing cash flow. So not surprised their net cash flow is massively negative. Yeah, ever since 2020. It's getting better. Okay, this is one positive sign. It's getting better, but that's nasty. Okay. Yeah, it looks like this internally is having problems. They're having problems running the business. And there are cracks starting to show on the shell. It's like one of those tongue twisters, right? There are cracks going, and you can kind of see it in the cash flow and the income statement, and it is falling dramatically. Okay, wow, negative 50% in a year. That's horrible. Did they really suspend their dividend? I should have seen that. That's a big miss. I should have known this was a Jeremy stock. Should have known this was a Jeremy stock. Jeremy buy a company with more than like a 1 to 4% operating margin. Challenge impossible. 99% fail this. Dividend growth. Well. Oh, so they suspended it last year because it looks like they did a cut. They tried to re-raise in 2020. Is it a very recent thing? Did they just suspend their dividend recently? So it looks like it's only been frozen the last year or two. That would be on the news. Lower than expected sales, week back to school. Nothing about the dividends here. 1 second. Get a full screen. Let me Google that. Foot Locker dividend suspension. That's the fastest way to tank your stock, other than material news, is suspend your dividend. Yeah, I don't see anything. Oh, here it is. Company suspends dividend after swinging to a loss. Okay, gotcha. So they did. What is that? Is that like a month ago? Oh, it's only a month ago. Makes sense. Okay. Yeah, something's going on with this revenue. How do you lose every year since 2021? That's a pretty significant drop too. 8.9 billion to 8.3. That's almost in line with 2019. It's not the worst. Oh man, this is gonna be a nasty drop right here. 2023. What's causing the revenue decline? Theft. Yeah, that might be it. Yeah, usually they would call that lostage. So you'd have to go into the actual filings to see what that is. Yeah. Theft. Well, then at that point, you're betting on the outcome of the elections to see if if somebody will do anything about crime or not. Yeah, that's a good point. Foot Locker is going to be a prime target for theft. They're just so easy to resell. Okay. Yeah, goes without saying, this is not something I would buy, even ignoring theft and the declining revenues. They don't know how to run their company. Their margins are fine. They don't know how to run their company though, and their products are flying off the shelves, one way or another. They're flying off the shelves. And I'm gonna take a risk. I am gonna look at their balance sheet, even though this site is a little bit flawed at doing that. 2371 current assets, current liabilities. Okay, current liabilities are fine. Long-term liabilities 2837. Okay, I don't see a terrible okay, I don't see a terrible debt situation here. It just looks like they suck at running their company. They're used to good times. They haven't changed. And they've got declining revenues on the horizon. So, yeah, this is a pass. This is a definite pass. Interesting. Yeah, I see a lot more stock picks right here, but I guess I could go to 2 hours. Yeah, I guess the target for these live streams, I just got to go to 2 hours. So we'll do that. All right, we'll look at a few more of these picks. Jeremy stock. This is horrible. I should have known. Jeremy. Only Jeremy would buy a stock that's down 50% on the year. I'm going to buy a directly consumer-facing, very popular retail goods in the middle of a crime spiking crime wave. But the dividend's high. Even when Jeremy picks blue chips, he still can't manage to do it, which is funny. Yeah, that'll be the challenge, to find a Jeremy stock pick that actually passes the test. Okay, so Atlas here, he wants me to look at ADC, ARR, NTST. Oh no, I'm sorry, those are not his picks. Let's see here. Trying to read the chat here. All right, Atlas wants me to look at PFE. That's gonna be Pfizer, or yeah, Atlas. Do you want me to look at NSA or PFE? Which one do you want me to look at more? between those two. PFE or NSA. I'll get them both loaded up. PFE is Pfizer, I already know that. NSA. National Storage Trust, interesting. Okay, down a lot on the year. Also down a lot on the year. Let me compare that to the general stock market. Yeah, general stock market's up on the year. These two were hit pretty hard. Well, if Atlas is not going to answer which one he prefers, Pfizer's kind of boring. I will focus on NSA. Unless he corrects the record here in a second. Alright, so it's got a really high dividend, which is usually not a good sign. Usually it means they're paying too high to begin with, or the stock price has gone down a lot, which means the dividend's high, which means they're going to cut it. Real estate investment trust, self-storage. Yeah, there are a lot of storage ones. Oh, looks like there's some good stats here, though. Wow, that is solid revenue growth. I guess, you know, Americans are pack rats. They are pack rats. 36, wow. That's wicked awesome revenue growth, okay. Cost of revenue looks fine. It's growing with it, but that ratio is fine. It's about a fourth. They know how to run their company. Selling general and admin is like a fraction of their revenue. Good. Really solid increasing operating income. This might be like a case study in like what's perfect. Net income. Okay, a little bit weird. Yeah, so then it trips out here on net income. Okay, something is happening. Oh, the interest expenses are cutting this up. That is why. They are sensitive to the increase in the interest rates, and they got annihilated. They must have had adjustable rates here on their debt. Yeah, everything is fine until the interest expense. You give Jeremy too much credit. He's been loading up on FL for 5 months. Yeah, I noticed that the last live stream. I was rewatching and I was thinking like, I'm way too considerate and gentle on these stocks. I would say things like, well, it's not the end of the world. At least the operating margin is 1%. And I was rewatching and I said like, no, this is trash. These stocks are on the verge of bankruptcy. They have months to live, if not like a year. And that's one problem I'm gonna have to fix. I don't do a ton of live streams, but I'm way too generous on these garbage stocks. I tried to correct myself by saying, well, keep in mind, relative to Tattooed Chef, it's not a total disaster. His stocks are atrocious, and I need to be more direct and upfront with that. Thank you for pointing that out, Tom Petty. Anyway, so it looks like what's happening here, everything is great. Again, gross margin's awesome, operating is awesome. It looks like they didn't do a good job positioning themselves on their debt. And as a result, yeah, they went from 34 million in 2017 to 110 million in their interest expenses. Now, this will be broken down on the other parts of the statements, but yeah, they're getting annihilated on their debt. So I'd like to see how that's broken down. And that's the problem, and that's why their net income is kind of choppy. Now they're managing to get through it, but that interest expense is creeping up. So I want to see what's happening there. That's the only demerit on the stock I'm seeing. And let's see the dividend here. It's going up. I don't really care about dividends though. Let's see if they are diluting their shareholders at all. Okay, they had some pretty heavy dilution years. But it makes sense. If interest rates are going to spike out, they would do that. Okay. All right, let's see what's going on here with the shareholders' equity. Going down, but still up overall. Okay, that's nervous. I'd like to see what happens next year. Let's see their cash flows. Operating cash flows are great. Yeah, they know how to run their company. Yeah, I mean, compare that to the stock I was showing before. These guys know how to run their company. They're spending money. That's good. They're finding places to spend their money. They're doing acquisitions pretty regularly. That's great. I like to see that. It's just the investing cash flow. It's more than their operating cash flows. That's not good. So they got to make up with it financing. And a lot of this is dividends. They're increasing it. They purchase shares. That's good, but they were issuing shares a ton before. So they're paying the company. They're just paying the dividends by issuing shares. Oh, surprise, surprise, right? This is why dividend investors, you don't have a free lunch. It's right here on the cash flow statement. 131 out in dividends paid, 900 in through share issuances, right? So there's no free lunch. I told you. Oh man, they're issuing a ton of debt. Yeah, way more than previous years. They issued a ton of debt the last 2 years. That would be it, and that's why they're getting annihilated there on their approaching net income on the income statements. Okay, net cash flows are... Okay, so they're just doing enough to keep flat near zero net cash flows. Okay. Yeah, I love this management team. I love the fundamentals. I love the statistics. I just think they badly executed on their debt strategy. Frankly, I'd like to see this company... I get why they have to do the REIT capital structure. There are companies that have moved out of the REIT structure, though. Yeah, I wish this weren't... I wish they deprioritized their dividend. I wish that they got their debt situation more under control. Because it's... I'm sorry, but the demerit from the debt is enough to really hurt the stock. I'm not surprised at all it's down 24% on the year. Still up a lot over the past 5 years, so it's doing better than O. That's good, but yeah, this last year has been hard because they tripped and hit their face there from 2021 to today with their debt strategy, and they're paying the price for it. See how much they're paying this. So interest expense, yeah, it's going up. They did $110 million last year in interest expense, and let me do TTM, and it's only worse now. Oh my goodness, yeah, 289 to 315. I'm sorry, yeah, that was the operating income, my mistake. 110 to 141, their interest, yeah, that's a massive increase. So 141 in interest expense versus 839 on their revenue. How much of their revenue is going to interest expense alone? Now remember, it's a REIT, so that's normal. I totally get that. So they make up with that by the fact that they don't have to pay taxes as much, right? I get that. 16.8% though. Let me compare that to something like O. No, I could be wrong. It could be better than O. I'm nervous about that. Let's see, interest expense. Oh, they don't have interest expense for O, really? Oh, I'm sorry. We need to be on the income statement. Where is interest expense? All right, 465. Yeah, O's ratio is going to be a lot better, I think. 3344. 13.9 versus 16.8. Yeah, so NSA's ratio for their interest expense, it's higher. It's significantly higher than O, and it's increasing. Let's compare that to O for their interest expense. Okay, so theirs was flat and they increased it a lot the last year. So it looks like O had the same effect as NSA, but O navigated the situation better. Probably because if I had to guess, they had this massive amount of cash sitting on their balance sheet. So that probably helped them weather the storm more than O. Now, this isn't a death blow. Again, this company's fundamentals, ignoring that, are way better than O's. That's the problem. Like, nothing is ever perfect on the stock market, right? Just like the dating market too, right, guys? But nothing's perfect. Everything is perfect except for how they navigated their debt situation. Such a shame. Okay. Well, anyway, let's see. Let's see. One more. So we got about 5 minutes left on the stock. I will take a look at Pfizer. If I had to guess, it's just gonna be really boring. So we'll see. We'll see. Negative 24% on the year, pretty much the same as this one, which is pretty funny. Obviously for dramatically different reasons. I don't need to look at it. I know what Pfizer does. What am I talking about? Wow, I don't know if it was Corona necessarily, but I don't know if it was the vaccine sales necessarily, but Corona was a lifesaver for them. Whatever it was, 2019, 2020 to today, they blew up their revenues and they were flat the years before. They were struggling before. I'm curious to see what this is. I should know because I used to be a biotech investor exclusively, which is interesting. But yeah, this is good, but also makes me nervous. If they return to the 2010s, it means this company's growth is over. But they've done really well the past few years for their revenue growth. The cost revenue scaled with it. But let me just check the ratios here. I guess I could just look at the gross margin. I need to stop doing that. Okay, the gross margin fell slightly, but it also came with a massive growth in revenue. Let's see if their net income grew commiserately. Okay, yeah, it looks great. Really big increases in their net income. I'm curious to see what's causing it. If I had to guess, they're probably buying back shares after a few good years like that. You bet they're going straight to do that. Yeah, share buybacks. Yeah, okay, that's good. Margins are awesome, 65, 34, 31. Before this happened, they had nasty, bad operating margins. Profit was good, but it's the operating margins that were bad. Okay. Yeah, it looks like their gross margin stayed about the same. Their operating margin dramatically improved. That's usually not something you see. Usually you don't see companies holding everything else steady but improving their operating margins. That's it right here. So they managed to decrease their selling in general and admin while blowing up their revenue. That's pretty good. You don't see many companies doing that. Credit where it's due. That's hard for a management team to execute on. Dividends growing, but the rate of growth is slowing down, but still the dividends going up. Not that that really matters. Again, these margins look pretty good. I don't see a reason to buy this other than just buying an ETF though, but still, not terrible. Cash flows are going up. That's great. Interesting. They're paying down debt. They're doing share issuances. They're losing money on their investing cash flows. Same thing in financing. These are usually good though. You'd like to see money coming in through operations and then out through financing. You don't like to see the opposite. If you see a massively negative operating cash flow and then massively positive financing and investing, that means they don't know how to run their company. Pfizer knows how to run their company. Okay. Let's see the past 5 years. Now, on their SEC filings, you'll see their revenue broken out by what product is doing it. So you'll have to see, a lot of these biotech stocks, what happens is, this happened to AbbVie too. They have one or two blockbuster products, and then legally they're entitled to collect the revenues on that for a few years. But then they become generic. They go to common, right? Any company can make them, and the revenues decline from that. AbbVie had a similar problem. Okay. Yeah, it looks like a standard dividend stock, pretty flat over the past 5 years. I don't like that, to be honest. Yeah, other than their few good years of, I assume, corona vaccine sales, Pfizer's been pretty mediocre stock. They failed in the 2000s. They grew in the 2010s. They've been flat since the last part of the 2010s. Overall, this is pretty much a pass, other than, I guess, people who are obsessed with dividends would watch something like this and buy something like this. Yeah, I don't know how much more they can really squeeze out of the corona vaccine thing too. It's possible though, because corona's endemic now. They might be able to keep squeezing that out, but that definitely was a lifesaver for them. Yeah, they're flat since 2018. Yeah, I'm not too excited about this one. Good statistics though. It's just the business they operate in. It's hard to do amazingly well in biotech. Unless you get bought out. That's the only way.
So, show Eugene support and hit that like button.
Yeah, thank you for saying that. I'm glad I don't have to. One of my goals on my YouTube journey here is I want to do this without totally killing my sense of self-respect. So you know how those other YouTubers do those thumbnails? I'm glad I have my VTuber model. The VTuber model I can use to make the YouTuber thumbnail faces, but me personally, I'm never going to do that. But anyway, I think that's the end of the stream here. I really appreciate it. Great chat here. It definitely blew up once I started talking about dividends. That's not a good sign. I'll have to correct the record on that one. I don't know when the next stream will be. I'm going to focus on making videos now. Next two videos will be about how to pay for video topics on this channel. And also, I'm going to do an attack on penny stock investors. It's probably going to attract a lot of comments of people saying I'm an idiot, but so be it. I attacked uranium penny stock investors a few months ago, or maybe it was a year ago. And oh man, they wrote me essays in the comments.
Well, is it true that uranium is having a crunch in supply?
Blah, blah, blah. And surprise, surprise, I didn't beat the S&P 500. So I'm going to do that again. For every 10 people that just sneer at you, there's one young guy who's thoughtful and they realize oh, wait a minute. Okay, I fell into a cult, or I'm making a big mistake. That's the type of person I want to reach. If you do the right thing, it's not as fast as being a total grifter sellout. If you do the right thing, you can grow slowly. So that's my plan here. Really appreciate that comment, Tom Petty. All right, that's the end of the stream for today. I'll see you next time. See you on the Telegram.